is
Appreciate
being
everyone being here
recorded.
today. We are going to be recording this appointment. Rebecca, good to see you. How are you doing? Herman, what's up, my brother? How
Good
are
morning,
you?
Johnston. Doing good. How about yourself?
Good, good, good. Got Edric Jason Hain. What's up, brother? How are you doing? Appreciate everybody being here. I see Rick, good friend Charlie Bart's here. We have our special guest Aidan with Flash Rays. He's going to be hanging out with us, telling us how to find some money. So he's going to help us with the money question. But we're going to go ahead and get started. We have a lot of people that are going to be jumping on. If you have questions, you can comment in the chat. I'm going to do my absolute best um, to follow the chat. Kathleen's here. Kathleen's in. We're working deals together. We're in business together. Kathleen, you can introduce yourself when you have a chance. Kathleen, I may have you help me with the chat. So if I miss anything, maybe you can help me with that if there are any questions, or you can raise your hand if you want to come on
I'm putting
camera.
my video on.
Cool, cool, cool. So everybody say hi to Kathleen. Jay Garrett's on here. Javier, our number one general contractor, is on here. So we got a good group jumping on. So this is our very first episode. Our goal is to have at least one call a week. Rick Fisher, my friend, good to see you. Um, what are we doing here? Real estate 101. So we have a lot of different people in our sphere that have different levels of real estate investing experience. Some people have tons of experience. I've been doing this a long time, lots of deals. Many of you have had the pleasure of doing some work with, like Edric. He's been putting up with me for a couple of years now. Some people are absolutely brand new, don't even know what you don't know. I want you to know that you're in the right place. So you're surrounded by experience, you're surrounded by like-minded people that are wanting to learn, that are wanting to grow. So we're grateful for everyone here. We just want to make sure that today we want you to get value out of today's call. So you can leave a comment if you want to chat. What are you wanting to learn? What do you want to get out of these calls? What are you wanting to learn about real estate? Are you wanting to find deals? Are you wanting to connect with people? So go ahead and leave in the chat. What is your takeaway? What are you hoping to take away from this? And then while you're doing that, I'll just tell you a little bit about myself. I am Austin from Houston. Houston is the city I love. So I love being here. We love doing deals. We do commercial and residential real estate. We've been very fortunate to do a large variety types of deals, whether it be flips and holds. We've worked with wholesalers. We worked with hard money, soft money, private money, you name it. We've done retail, multifamily, duplexes, triplexes, fourplexes, 60plexes. Um, we've done vacation rentals. Even done some wraps, subject twos. So we want to talk about all those things in the weeks to come. Rebecca, I'm looking to get remotivated. Oh, yeah, we're going to get you remotivated to start my investing, immersion therapy. That's good. Well, you're in the right place. So we want to talk about how to get started investing in real estate. Well, Christine, good news. You've already taken the first step by surrounding yourself with people that are doing it. So that's one of the best ways you can get involved is by getting involved. So what's our mission with this? Well, I want to communicate this. There's four purposes that we have with this call, the REI 101 call. Number one, we want to simplify the path. So we want to break down real estate to clear, actionable steps that anyone can follow. So number one, simplify the path. Number two, we want to empower every role. So whether, there's some people here, they have more time than money. Some people have more money than time. So different people are going to play different roles. So there's not a one thing that people do, despite, maybe what some people believe. There's a lot of different ways that we can get involved investing in real estate, as well as working together, partnering on deals. And so whenever I introduce two people together and they end up doing a deal together, that makes my heart so happy. So to see that I can play a role in just connecting people. Then number three, connecting the right people. So you're here. A lot of you don't know each other, but guess what? I know every single one of the people on this call, so I can vouch for all except for one person. and I'll tell you who that person is later. I'm just joking. Everybody here is incredible, and I love all you guys for being here. And then finally, build wealth and build wealth with a purpose. We don't want to make money just to make money. Money is only good for what it can do, for the good that it can do. So we all want to do good things with our money, and uh, that's it. So appreciate y'all jumping on, learn stuff, source deals, potential JVs. Mehul, thanks, man. Thanks for being here, Mehul. So what I want to ask, one question before I introduce our guest, is what is your experience level? And what I want you to put in the chat box is I want you to put a number. How many deals have you done in the world of real estate investing? So I'm going to go. I'll just go ahead and just type in the box. If it's zero, put zero. Be honest. If it's one or whatever, how many deals you've done, go ahead and put. So we got zero, we got one, dozens. So a lot of people. Oh, that's my uncle Derek. Everybody say hi to Derek. 10 plus 11. Yeah, so we got some good experience in here. So a lot of people getting started. I love it. Appreciate y'all being here. So 9. Okay, excellent. Excellent. All right. So I don't know if y'all are watching the stock market. It's not looking too good, right? This is not our first rodeo. Do you see my post from Matt Teeter the other day? If you're 35 or older, you've been here. We've done this. Remember this quote from David Green. And David Green's one of my friends. He's an author that I will quote a lot. He's actually a Keller Williams agent, former host of the Bigger Pockets podcast. The deal of a lifetime comes around once a week if you are prepared. So you go back to 2008, and that was a rough time for people, but somebody won. Somebody made a lot of money doing that. So if there are deals to be found, if there are deals to be made, they're gonna exist in these types of times as well. So we're gonna be talking about hard money today. I've got Aidan from Flash Funding on right now. Aidan, why don't you come on? Let me introduce you to everybody. So one of the first questions that people have when getting into real estate is how do I fund these? Because you can't always just go to the bank and get a loan for a distressed property that needs 40, 50, $60,000 of work. Aiden, why don't you tell us a little bit about yourself and Flash Raise and what doing business with you looks like?
Yeah, sure. So first off, I'm honored to be the first guest, man. This is it's a great crew you got here. There's a lot of deals in this chat, so happy to be a part of this, and honored to be even considered as an expert in the field. So I've been at this a little while. I started lending back in 2013 from the natural pipeline of bartending on Sixth Street, um, directly into being a hard money lender. Started at a company based in Austin called Streamline Funding, and really cut my teeth there and grew up in the space a little bit. Bounced around a little bit after that, and in about 2021 ended up at a company called Lima One Capital. Lima One is a more kind of, they're a little bit more in between bank money and hard money. It's kind of institutional hard money, which I'll talk a little bit more about in a minute. But yeah, spent some time there, ran the middle part of the country for Lima until I was just ready to make a move out of there, and teamed up with Flash Race Funding. We're based here in Texas, and the other two partners, Jeff Katz and Justin Carpenter. Jeff started lending in about 2005. So between the three of us, there's 40, 50 years easy of hard money lending experience here. So yeah, we've been at this a little while. Flash Raise. The fund has evolved a little bit over time. Right now, got about $80 million, 85 million in assets, and then those assets are the loans inside of the fund, right? So So yeah, decent size enough to be able to make some big rips and do some exciting deals, but small enough that we're nimble and get to, pick our battles and get excited about whatever we want to and be able to spend our money accordingly.
So, for those of us that may not be familiar with hard money, and I know there's some experience in the chat, but how would you explain what hard money is, or what's different between a hard money loan and traditional finance?
Yeah, sure. So I'll kind of separate um, all three of the main types of lending out there at the moment. So obviously you have your traditional conventional funding, bank money, right? And that's one of the biggest differentiators. What's really at the core of all these type of lending and what makes them different is where the money's coming from, right? Because where that money coming from is decides what it can go to, right? How difficult the process is, how easy the process, what types of assets, what type of borrowers, right? So it's really going to define the full step of this process from start to finish. So starting out on one side is conventional lending, and that money comes from the GSEs, right, or the government sponsored entities. So lenders close loans, and with maybe their own funds, maybe with bank lines, and immediately sell those off to the government sponsored entities, which are Fannie Mae and Freddie Mac. I'm sure you've heard of those, right? And because those are underwritten by the government, they have to fit into a very strict box. The properties need to be in very good shape. The borrowers need to be um, have a lot of cash flow and generally good credit. Then on the other end of the spectrum is hard money, right? And hard money comes from just about wherever we can find it, right? And depending on the hard money lender, it may be big groups of investors, it may be small groups of investors, and maybe people putting in 40, $50,000 at a time. It may be people putting 4, 5, $10 million in a time, right? And even within hard money lending, the type of investors that you get that capital from to put to work can also define where that money is going to go, right? Like earlier in my career, we did what's called fractional funding. Um, and let me take a step back before that. So most hard money lenders operate out of funds, right? And create these funds and dump money into those funds so that we can then use those as our funding sources. And when we close deals, money's coming straight out of those funds in order to close these deals. Multiple things happen from them, right? Either those funds are then extended with bank lines, and the bank money comes in to help to put more money to work, right? So we can leverage out our own cash. But it's very different than selling a note to a bank, right? We hold the loan on our own books, and we may leverage out, but then we're leveraging the actual loan, the actual note, instead of selling the loan to get money back to replace those,
Right.
right?
So it's this, you mentioned a spectrum between conventional financing, hard financing. On the conventional side,
Mhm.
typically those are going to be for longer term deals. Is that right? And they're going to be backed by the government and resold to a third party. Um, anything. So, what type of deals qualify for hard money? If I have a deal I'm about to buy, why would I consider hard money instead of conventional financing?
One of the biggest differences between them, as far as how you, the investor, experiences it, it's going to be leverage, right? The bank is going to be a lot more conservative on leverage. They're going to want a lot more cash down, and generally, with the exception of a few very small, very niche government loans, they're not going to provide any money for rehab. Right. So hard money is specifically made to help take down these properties, but also to be able to finance the rehab, right? So instead of a bank where you're going to put 20% down just on the purchase of that property, and then let's say you've got 50K in rehab you need to complete, you're bringing 20% down plus the 50K in rehab. Now, the way that hard money looks at these loans is okay, you're buying this for $200,000 and you're putting $50,000 into it. The total cost of that project is $250,000. How much am I going to fund of this $250,000 project as opposed to the $200,000 house? So the leverage is going to be a lot more, a lot higher on hard money loans because it's generally a riskier loan, right?
Right. And the
But
terms are generally shorter, aren't they?
terms are definitely going to be shorter. Yeah, the standard hard money loan is going to be about 6 months to 12 months, as opposed to your standard 30-year term. We've
Okay.
got a few different options that are kind of cool. We've actually have a 5-year loan, which is not it's not standard at all in hard money. Usually 6 to 12 months is going to be in that range. But that's kind of the benefit of having all your own cash, right? Um, even within the hard money space, like I was saying, a lot of people raise those funds differently, and we have a very small group of investors that we have in our fund. So we get to choose really whatever we want to do with that money, right? And we leverage those out with bank loans on the back end for those notes so that we can get a lot more flexible with our terms and we
Got it.
can offer that 5-year term. It's good enough for somebody to close and have a little more time to pay it off if they have trouble with permits or whatever else, or like right now there's a lot of uncertainty obviously in the
Hmm.
markets, and nobody knows where those rates are going to head. Are they going to drop? Are they going to stay? And maybe you want to give a little bit more time before you refinance out of this loan, and you want to keep a property and put a tenant in there, right?
Yeah.
It gives you a little more time to figure out what you're going to
So
do
the
on the back end.
So let's talk 1 second about just flipping houses, which I think
Hmm.
a lot of people are interested in, and then financing terms for buying and holding. We can talk about that as a separate thing. So
Hmm.
Don's asking about interest only. So walk us through. I find a house. They're asking, let's say they're asking 150,000. Me
Yeah.
and Javier, our contractor. If y'all don't know Javier, y'all need to get to know him. We walk through the house and we decide that it needs about $50,000 worth of work. So $150,000 house, it needs $50,000 work. My agent, who is me, runs the comps and says, I feel comfortable that we can get this on the market and sell it for 250,000 or more. So roughly, with the exception of fees, there's about $50,000 of possible profit in that. So on a house that I can buy today for 150, what first of all, what do I need to have in my pocket to move forward with this option? And Don's asking about interest only. And Liv is asking, is this hard money mostly for flipping? How would you guide somebody through that process?
Yeah. So I'll go first to the question on how much cash is needed in pocket. Frankly, it depends based on the lender, right? So the gold standard in the lending industry, especially hard money, is 70% loan to value, right? Some lenders might creep over 70% loan to value, but it's rare, right? And if they do, it comes with a lot of strings. So that loan to value is based on the after repair value, right? So it's based off that $250,000. So 250 times 70% means that the max loan on something that's going to be worth $250,000 is $175,000. So you've got 150K to purchase, 50K to rehab. That $200,000 means that you're going to have to bring $25,000 to the table because our loan is 175. You need $200,000 total. So you're going to bring 25K to closing plus closing costs, obviously. And that's the general formula you're going to want to plug into just about any deal you see. If you're just trying to figure out how much cash you need out of pocket, find out what 70% is, find out the delta between that 70% and how much cash this project is going to take total. And that's going to be a good starting point for you.
Rebecca brings up, she said that she used hard money for a buy and hold. So if we see a property that needs that $50,000, but instead of selling it for 250,000, if we can possibly rent it for
Mhm.
2,500, which we'll talk about the 1% rule
Yeah.
more in episodes to come. But if that, would we keep that hard money loan while we hold the lease? Or what would you suggest to somebody who decides, hey, this house looks great, but I want to hold on to it. I don't want to
Yeah.
sell it. I'm going to lease it out.
Yeah. So I'll jump back to my where the money comes from conversation because it's
Hmm.
important in exiting a hard money loan or moving on to the next part of it, right? And there has been a space carved out in between hard money and bank money that's more institutional capital, right? It's underwritten somewhat similarly to hard money and definitely has its roots in hard money. But how it came about is hard money's been around for a while, right? And it's been making lots of money for investors for a long time. And there's only so long that you can make money off of something like that without Wall Street finding out about it. And essentially enough data was collected on hard money loans that there was a way for institutional capital, which is, money coming from insurance companies, money on Wall Street, big hedge funds, to be able to invest in these properties, right? In these loans themselves. Um, but because that money is uh, it comes with more strings attached than just using your own cash, right? So it kind of pushed closer to bank money than hard money. But it's going to be a little bit more leveraged than banks, but still come with a lot of conditions. And so in that space, the DSCR loan was kind of born out of that. And the DSCR loan is what Burr investors use after they close the loan with the hard money to push it into something more long term. And the DSCR stands for debt service coverage ratio, right? And essentially, what these lenders want to make sure for these loans, because these are 30-year loans, these are 30-year fixed mortgages generally. And they're going to be somewhat comparable to what a conventional mortgage are going to be. It's going to be a little bit over, right? Like these days, I'm seeing kind of low to mid sevens for those DSCR loans, right? So it's approaching what conventional loans are, but a little more expensive. And like I said, what they want to see is they want to make sure that it, so a bank loan is, and sorry to jump back, a bank loan is written off of debt to income, right? It's how much money do you make as an individual, and will you be able to service that note? Will you be able to make payments safely, right? Hard money is based on the end profitability of that deal, knowing that a lender can close this loan and it's going to make money on the sale, and that's their security. And if something goes wrong, they can sell it because they know that there's a gap and somebody found a good deal.
So a
With the
conventional
DS,
loan's gonna look more at your credit score. They're gonna look more at your income, your
Mhm.
debt to income ratio.
Exactly.
Whereas, is it easier would you say it's easier to get a hard money loan if my credit is bad?
Far easier, far
Yeah.
easier. Like we at Flash Raise, we actually don't have a credit minimum. That's a little rare, but like I said, we're a smaller, more flexible shop. So you bring us a good deal, we can see the value in that deal and say, we know worst comes to worst. If a tractor beam comes and sucks you off the face of this earth, that we have that property and we can figure out what to do with that and we'll be okay, right? That's what our entire fund is based around. Now the DSCR loans are kind of underwritten and operated as a business, right? They
Mm-hmm.
want to see that the income, the monthly income from this property that you're going to close, this rental property, is going to be greater than the total debt service, right? And that debt service includes principal, includes interest, includes taxes, insurance, if there's condo, HOA charges, everything like that. Essentially looking at it more of like a multifamily asset, even though it's a single family, and saying, what is the net operating income after you've paid everything you need to pay every month? Are you still making money? And that is the bare minimum it has to make money, which, talk more about the 1% rule in
Yeah.
the future, I'm sure, but it's a pretty good barometer right now where the rates are of a bare minimum what's going to pass in a DSCR loan, right?
Yeah.
Is the look at the loan versus the monthly income and find that 1%, if you think it's going to be $100,000 DSCR loan, make sure that it's at least $1,000 a month producing an income because if it's not, it's not going to pass the test on a DSCR loan. So it's very important to kind of know some of that up front when you're getting into a deal. If you think you might be looking for a DSCR loan on the back end, because a lot of investors run into that issue where they close a deal and they're looking to make it a BRRRR, they're looking to take it out on
Right.
DSCR, but that property is not going to qualify. So they need to know that. They need to know that DSCR loans are also a lot more credit intensive, right? So if you have below a 660, you're going to struggle. If you have below a 620, forget about it. Other important things to take into account, those DSCR loans, they require a good bit of seasoning. That's the lending term, is seasoning. Time under that loan, right? So hardly any DSCR loan is going to let you refinance into that DSCR loan out of a hard money loan in less than 6 months, right?
Okay.
So
So
again,
there's a timetable there that you have to abide by.
exactly. So know what you're getting into in the front end of the hard money loan as well to make sure that you're not going to get in trouble on the back end when you try to refinance. If you have to pay it off in 6 months and that DSCR loan needs a year of seasoning, you already set yourself up for failure, right?
Another
So
another
make sure
thing
you know
that
the
you
plan all the way through.
right. Another thing that you brought up, that it's important that whether we end up flipping it or holding it as a long-term rental, we have to know our numbers, right? And so if you don't have a good way of estimating your rehab costs, if you don't have a good way of calculating or estimating your monthly expenses, if you do decide to hold the property, well, we're going to be talking about that. And I know it's 12:56. A lot of people need to get back to lunch. We're going to go until 1:15. So our plan is to do this for 45 minutes. But let me ask the chat, first of all, housekeeping question. We have a lot of people that are interested in jumping on these calls, but they can't during the day. If you are open or interested in doing a 5:30 call, can you just say interested or raise your hand or put something in the chat? Let us know that if we did do a 5:30 call, you'd be more interested in the 5:30 call. I want to hear from you. Okay, so we got one. Hey, Graham, good to hear from you. So we do got some interest in 5:30. Meta, I hear you. We may end up probably just doing both, just so we can um get with more people. Herman, they would probably both be on Mondays, both be on the same day. So we'd do one at 12:30 and one at 5:30. So I think it'd probably be worth shooting doing. The other thing I wanted to ask the chat, and maybe you don't know the answer to this, are you, and by the way, we've only talked about two ways that you can make money in real estate investing. Someone asked me about passive investing. We're going to definitely get into that. And in fact, when it comes to hard money flipping houses, we've had people on in our circle actually do nothing but front the down payment, partner in with somebody who had more time and energy. In fact, I did this with a partner where one person will kind of just manage the whole deal, oversee the contractors, and then report out to the other partner who has more of the money. So
So
yeah,
yeah,
there are ways to be more passive in this if you are interested in partnering with other people. So by getting to know people, I think that's going to give you a big opportunity right there. Um, Moving to the next thing, what I wanted to ask, Aidan, what are some of the risks involved specifically with hard money? So I know the interest rates are going to be way higher. So right now, interest rates for conventional financing are averaging about 6.65 at the moment. First of all, what are the interest rates looking at like for hard money?
they so hard money is going to be generally a little less. Um, it's going to fluctuate a little bit less than conventional financing, right? Because conventional financing is tied a lot more directly to the indices, right? So the treasury notes, um, and indexes along those lines, right? So that's going to move those a lot more, which is tied more directly to the markets. Hard money, because it is just folks' capital that they're putting out and they expect X returns are, it's going to be a little more consistent over time, right? And right now, I mean, true hard money is generally anywhere from 11 to 13% interest, right? And obviously that's a lot higher than a conventional loans, but it's a different product, right? It's because it's a lot more risky, and it's a lot more short term, right? These hard money lenders come in, even though it is truly debt, right? It is a lien on the property, that is there in exchange for interest. Um, we act a little bit more like a partner, right?
Hmm.
Because we are taking so much more of um, an aggressive line here. We're providing a lot more leverage than the banks would. And also, yeah, it's short term, right? So most investors are out of these hard money loans in less than 6 months, and even at 12%, um, you are paying less than 6% total on your money if you get out in 6 months, right? Because that's 12% for a year, essentially a percent per every month, right? So you're putting a lot less cash into it just because of the length of the project.
Hmm. No, that's very helpful. You mentioned risk. In your experience with hard money, with flipping particularly, what are some of the risks that you've seen, or what are some of the potential pitfalls that you've seen that new investors need to be aware of?
It's something that can be, I think, stretched across many disciplines, right? But it's the number one downfall that I have seen throughout my years is people just getting too big too fast, right? Especially the worst offenders are folks who have a lot of success, right? You come in quickly and do a couple big flips, make six figures on a few flips, and you really get charged up, right? You think you got this thing down and let's go big, right? Next thing you know, they've got 10 projects under their belt at one time. Now, obviously, you can get in and out of these fast, right? That's what these loans are made for. That's what these type of investments are made for. But you don't always, right? And when you got 10 under your belt, a couple might go wrong. A couple might stretch out. Now you've got a couple $1 million in debt at 12%, and those projects drag out. Those are big interest payments, right? So that's the biggest thing that people get smacked on is over leveraging themselves a little bit by taking on more projects than they are prepared for, right? So even if you have success, you got to take your time and you got to build up a little more slowly because these things will come back if you put too many on the table at one time.
So doing too much, too fast, too many deals at one time. I don't think we have a lot of people struggling with that. Any other challenges? Rebecca mentioned underestimating your rehab time. How do you are you involved with the rehab? I mean, do you how do you know that we know what we're talking about? How do you assure that the client, that the borrower knows these numbers correct? Because I'm sure everybody who's done deals, they
Mhm.
budgeted X and it ended up costing Y. I know that's very common. Like, how do you handle that?
Experience, right? It's when you do enough of these loans, right? I mean, we do 20, 30 or more a month, right? So we look at a lot of deals, which is why we're also a very good resource, right? When you've got a good lender, check in with them and use them as a sounding board. Use them as somebody that, has been there before and seen these things go through and has seen them fall. Um, and we're going to be honest with you. We're going to tell
Mhm.
you if you're way under budgeted, or even if you're over budgeted, we're going to be like, hey, what's all this money going towards? Because you said you've got a cosmetic rehab on 1,200 square foot home, and you've got $100,000 budgeted for that. Like where is all that going? Right? Because you might be over budgeted and overbuilding for the area. And so it's just something that comes with time and coming with seeing a lot of deals, right? And that plays into our own risk factor a lot, right? Because if you're under budgeted, you're not going to have enough cash to finish that project and it's going to fail. And no lender wants the project to fail because it's far more of a headache to have to take a property back and figure out what to do with that project after than it is just taking on successful projects.
Yeah, and that's why it pays to have a contractor or contractors that have the experience, that are honest, have the reputation, and may not always be the lowest bid. I think a lot of people with experience know that sometimes the contractor with the lowest bid is just inaccurate with what they're quoting. So if you have a contractor, I had a contractor one time that gave me a bid on a rehab, and I did this deal with Flash, by the way, and he would not itemize the bid. He's just like, here's everything that needs to be done. It's going to cost $45,000. And when we asked him, like, I need to know line by line, how are you getting to that number? How much are the floors going to cost? How much are the counters going to cost? So all those things are, you look at those line by line, do you not? Are you looking at those bids from the contractors?
Yeah. We definitely do. It also depends on complexity. If we've seen the pictures on the property, um, and it's a small budget and it's cosmetic, a lot of times it will kind of make sense. But especially, we want to know if there's anything weird happening, if there's any big improvements to the property, adding square footage, anything that adds into those risk categories, right? We just want to understand the deal a lot. So yeah, especially on bigger budgets and budgets where there's something funky going on that's bigger than just, replacing floors and countertops and appliances. Yeah, we're going to want to dig into that. We're going to want an itemized budget because if that can't be provided, it's a red flag from the start, right?
Yeah, 100%. And also for everyone, I think it's an important question to ask yourself, what do we do? What do we don't do? What is important in if we're going to flip a house or buy and hold? Unfortunately, I think a lot of people that watch HGTV more than they actually look at real estate deals and look at the data and talk to people who are actually doing these deals, they may have a tendency to over improve. And so we want to avoid over improving. We're going to talk about that in future episodes. When you have a deal, what should we do and what do we not need to do? It's going to depend on the deal. So we're going to talk about that. But right now it's 107. I want to take a few moments. If you have questions about hard money, questions for Aidan, please leave those in the chat box. Meta asked, "How about holding and renting?" So, what I'm understanding, what to ask Meta's question, if I see a house, so say my goal is to acquire assets, and I want to build a portfolio, a rental portfolio, one asset at a time. I come across a property that is dilapidated. It has extensive deferred maintenance. It needs repairs. It needs a new roof. You're the guy to come to. But if I decide to hold it, then at some point during those 6 months, I'm going to complete the rehab. So you are on a timeline. And then once I complete that rehab, I want to refinance it to either to a DSCR loan or conventional financing. Is that your question, Meta, that you're asking? And Aiden, you can speak into that. That's
I'll go ahead and jump in there. Yeah, so for hard money specifically, especially these short-term hard money loans, the number one reason that it is used is for value add properties, right?
mhm.
This property is not going to meet the market where it sits and it needs to be improved, right? So that's how hard money is used to help be a bridge to DSCR financing. Can be used other ways if you are, let's say you're buying a rental property that's already in good shape. Yeah, generally you're going to want to jump straight into a DSCR loan or something long term with a better rate because it's about your long term cash flow, right? But the way hard money might be used there is, like a lot of deals, you got to close really fast, right? And any type of DSCR, conventional lending, you're looking at usually 3 weeks minimum, right? And you find a great deal from a wholesaler, maybe they're not going to give you 3 weeks. You got to close it fast, right? So that's a situation where hard money can be useful for still helping to bridge that, but it's such a good deal, you just can't pass up on it, and you got to move fast, right? You don't want to take down a hard money loan with the end goal of being a rental property if you can't qualify for that
Yeah.
rental loan, right? Make sure you can qualify. It's something else like just the speed or the pure timing of it. But if it's like, hey, I can't qualify for that DSCR loan, but I need to take this down hard money right now, rethink that strategy.
Yeah, so there's a couple of creative ways that we can approach that meta. Like number one, the simplest would the simplest answer to that question is make sure that you can qualify for a long-term loan before you get into the project if your goal is to hold that property, because you'll pay off that hard money loan when you refinance it into a conventional or DSCR loan. However, if it's a deal, if you find yourself in a situation where you're rehabbing a property and for what one reason or another you can't qualify for that loan, well then you have a couple of options at that point. Number one, sell it. Just go ahead and sell it. Go back to the drawing board. Number two, you may have a friend in the real estate business that can connect with you with a partner that can help you qualify for the loan, maybe share some equity. So there's some creative ways if you know some people or build relationships, and that's really one of the key things to being successful in real estate investing. It's by building your database and really building your relationship with other people because I can tell you just by looking at people that are on this call, I see people that are doing deals in ways that you wouldn't have thought about. My buddy Alberto's on the call. We're doing deals together um, in a very, very different way than what we're discussing today. So, Aiden, before we finish, we've got 3 more minutes left on the call. How do we get a hold of you? And when we find that killer deal, how do we move quickly?
Yeah, well, I put my email here as my name, so please take my email down. Shoot me a message. I'll drop my phone number in the text as well. That's the easiest way. And then as far as actually getting a deal done and getting approved, um, like I said, we are very low barrier to entry. At Flash Raise, all you got to have is a good deal, right? The two things that every lender in the world is going to make sure that you have as a qualification are that you do not have any open judgments and you don't have any tax liens, right? Because what those do is they attach to the property itself, right? They jump our first lien priority. We are no longer owed our money first. The government or whoever you lost that judgment to is owed that money before us, right? So as long as you've got those, you're pretty much qualified. We've got an online application. We want to make sure you got enough cash to close the deal and to make a couple months of payments. So find the deal, send the budget over, make sure you got enough cash to succeed on that deal, and that's on you. But as long as we've got those boundaries hit, then we're good to go.
So in the next few weeks, this month we will be talking about how to find deals, how people are finding deals, how to identify deals. Also, next week we're going to talk about time versus money, money versus time. Um, Maybe you're new, or maybe you're not new, and you're wanting to get more specific. There's different roles in the real estate world that you can play, whether it be a deal finder, a deal funder. Some people just find the deals and assign them to other buyers. Some people find the deals and bring in partners. Some people find the deals, don't have money, but are able to put sweat equity into the deal. Some people have more time. I mean, some people have more money than time and they're looking for more passive opportunities. So, Aiden, appreciate your time today. Very grateful. Thank you for everybody for being on our first call. Um, Debt to income ratio. I want to get this question in. We got a couple of questions we do want to hit real quick. How much do hard money loans take debt to income ratio into account? Like if you already have a mortgage, did you want to
I
answer
have
that?
I have never met a hard money lender in my life who cares about debt to income. So
That's the answer. Yeah.
don't worry about it. It's about how much cash you got on hand. Sometimes it's about your credit, sometimes it's about your experience, but DTI will never come into play with a hard money loan.
And then other than the 30% after repair value that we need to be prepared, what are there any other fair fees? And then the interest rate, of course. You said 11 to 13% interest. Any other fees that we should be budgeting for hard money loans?
Yeah, I mean, always ask for a full term sheet and full breakdown, right? Just about every lender is going to charge a processing fee. A doc prep fee is going to go to attorneys. You're generally going to pay for an appraisal, or even if they don't get an appraisal, they're going to charge you for a BPO, right? Getting the escrow account set up, pulling your credit, little things like that. None of those are really going to break the bank. They're all pretty negligible, but you know, check out those day one fees like processing and doc prep. This sometimes the numbers can sneak into there that push it up a little bit. An underwriting fee is sometimes tacked on top of a processing fee, and just get that full term sheet and look at the full breakdown. Look at every dollar that you're paying.
Got it. Got it. Okay. Well, we do definitely appreciate it. Appreciate everybody jumping on the call. Hey, we're going to email everybody the notes. We did record this video, so we'll be posting that to our YouTube channel. Thanks for jumping on the call. Did anybody else have any other questions before we wrap up for the day? It'll be 5 seconds.
Thanks for having me, guys.
Thanks, guys. Thanks for being on. Appreciate y'all. And we'll see you next Monday, 12:30. Have a great day. Bye.
The